Chinese? Is coal the new oil? New Chinese funds and a market update. General Motors posted another record loss this week and now wants to lose its union labor force. GM is offering buyouts to all 74,000 union workers in the United States. This is yet another sign that GM is shifting its production overseas, and I expect a lot of it will end up in China. GM says its China operations are the one bright spot for its future. Last year, GM sold over 1 million cars in China, a surge of 18.5%. Indeed, GM is poised to overtake Volkswagen in the success of its Chinese investments. Just last month, GM and Shanghai Automotive Finance sold almost 2 billion yuan worth of bonds backed by its car loans, the first ever securitization of car loans by an automobile financer in China. In its efforts to fast-track production of the Chevy Volt electric car, GM announced Monday a new global organization for hybrids and electric cars that will be partially based in Shanghai. Though through a German consulting firm, GM is recruiting engineers and senior managers for a future operation in Shanghai. And visitors to Detroit's new international air terminal are greeted with Chinese announcements, signs, and even a China UnionPay ATM. UnionPay is the ironically named debit card network in China. Detroit is ready for an influx of Chinese moneymen and business travelers when the new Northwest Airlines Detroit-Shanghai route starts a year from now. Across the Detroit River in Ontario, the Canada-China Business Council is actively encouraging Chinese direct investment in the region's depressed auto and auto parts industries. China's actual foreign direct investment in Canada is nearly $1.5 billion, with more anticipated. All this activity makes me wonder why opportunistic politicians in America are so worried about the Mexican border when parts of Michigan and Ontario may become Shanghai suburbs. Stock markets reopened and are broadly down with what I call a hongbao effect, cashing out in the wake of spending on New Year lai or gifts of cash and other expenses such as traveling or partying the nights away during the week-long holiday. The Shanghai Composite Index fell sharply in the first hour of trading February 13, struggled to make its way to my 4,600 baseline, and closed down at 4,490.72. The CSI 300 Index, Shanghai and Shenzhen B shares were much the same, with 2 or more % declines February 13. Markets in Hong Kong rebounded by about the same amount, while Taiwan shares are flat. There is renewed bullishness on Chinese stocks from big investors. Morgan Stanley's call is up for emerging markets equities, and there are several new funds. The investment targets are Chinese financials, property or real estate, select big Chinese state-owned and mixed ownership conglomerates, Hong Kong red chips, and investment is aimed at Greater China, with Hong Kong, Taiwan, and Singapore all in the mix. The trend is China's domestic growth and the companies that benefit from the unstoppable urbanization of Chinese society. Barings Asset Management of London will premiere 2 new China funds in May, the Baring China Growth Fund and the Baring China Select Fund. The Select Fund will be open-ended. The funds will be managed by Baring's Hong Kong China Fund team. Another London-listed fund, JP Morgan Chinese Investment Trust, claims it can pick the long-term winners among Chinese stocks. Manager Emerson Yip told the London Financial Times the fund looks for strength in return on equity and focuses on industry leaders such as China Mobile, which makes up almost 10% of the fund's holdings. Legg Mason and Citibank China will bring mutual funds to Chinese individual investors this year. Many Chinese want to invest in other emerging markets, and the potential is enormous. According to one market analysis, Chinese mutual funds assets may grow to almost $1.5 trillion by 2016. At the end of last year, China passed Japan in net flows to long-term mutual funds. Remember, as Chinese invest in these mutual funds, capital amassed in China will be returned to China's traders and investors. Will 2007 be remembered like 1993, the year China became a net importer of oil, with massive implications for world oil supply, prices, and energy security? Last year, China became a net coal importer, despite being the world's largest producer of coal, with the 3rd or 4th largest coal reserves. The reasons behind China's coal squeeze are many. Reform and consolidation in China's mining industry. Beijing shut down around 10,000 inefficient and dangerous mines. Transport remains a problem despite great expansion of railways and highways. incredible demand for coal by China's power industry and huge rural population, and a recent ban on exports from Beijing to build up coal reserves after the unusual and unusually long winter cold snap in central and southern China. The result of China's hunger for coal is major pressure on world prices as global demand can't be met. Japan normally relies on China for a tenth of its coal imports. Both the U.S. and China have many new coal-fired power plants under construction as they turn to coal to lessen their dependence on Middle East oil. The question then, as featured on page 1 of Tuesday's Wall Street Journal, is will Chinese demand do to global coal prices what Chinese demand did for oil? If so, it could lead to further inflation as some major economies shrink, the perfect recipe for stagflation in America, Japan, and maybe even Europe. Of course, for investors, there's always an upside. Appalachian coal futures doubled over last year's levels, and exports of coal to China is opening mines and creating jobs in many of the most declined areas of the United States. I'll see you next time.
Kirk Unit, disclose the information.